A 13.6% yield, paid monthly, from the Nasdaq 100. That sounds like the answer, right? Just buy QQQI and collect the checks. But here's what most people don't look at. The fund paying just 9 to 10%, GPIQ from Goldman Sachs, has delivered roughly 32% total return over the past year. QQQI, about 26%. The lower yield fund grew your money faster, and that's the part nobody talks about. So today, I'm going to break these two funds apart, side by side, category by category. By the end, you'll know exactly which one belongs in your portfolio, and more importantly, why picking the wrong one could quietly cost you thousands. And here's the detail that surprised me most. The tax story between these two is not what you think. We'll get there. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, if you had to pick one number to judge a fund by, yield or total return, which one would you choose? Hold that answer. By the end of this video, you might change your mind. Let's get into it. Two engines, one index. Here's what makes this comparison interesting. Both of these funds own the exact same stocks, almost identical portfolios, same top 10 names: NVIDIA, Apple, Microsoft, Amazon, AMD. QQQI holds about 104 positions. GPIQ holds about 106. Both have roughly 45% of their money in the top 10. If you looked at just the stock holdings, you'd think these were the same fund, but they're not. Big difference. The way each fund turns those stocks into income is completely different, and that one decision, how they write options, changes everything: growth, yield, taxes, all of it. Let me break it down in plain English. GPIQ, Goldman Sachs, uses what's called a dynamic overwrite. They sell call options on somewhere between 25 and 75% of the portfolio. And here's the key. Over the last 12 months, their average coverage was only about 36%. That means roughly 64% of their tech stocks were totally uncapped, free to grow, no ceiling. When the Nasdaq rallied in early 2026, GPIQ captured roughly 85% of the upside. That's why the total return has been so strong. Now, QQQI, NEOS, takes a different approach. They write call spreads directly on the NDX, not on individual stocks, on the index itself, and they manage toward a target, about 14% annual income. That's a bigger payout, but it means more of the upside gets traded away for cash. Think about it this way. Imagine you own a rental property. GPIQ is like renting out one bedroom and letting the rest of the house appreciate. QQQI is like renting out the whole house, maximum cash coming in, but you've capped how much the property itself can grow. Same house, same neighborhood, totally different strategy. And here's what that means in real numbers. When the Nasdaq ran hard in early 2026, GPIQ's lighter coverage let it capture roughly 85% of the upside. QQQI's heavier overlay meant it captured less, still solid, but noticeably less growth. In flat or choppy markets, the story flips. QQQI's bigger premium cushion holds up better because you're collecting more cash along the way. Neither one is wrong, but they serve very different goals, and that matters a lot depending on where you are in life. So now you know what's under the hood, but the next round, fees, is where one of these funds pulls way ahead, and the gap is bigger than you guess. The fee fight. This one is quick, and it's not close. GPIQ charges 0.29%. QQQI charges 0.68%. That's a gap of 0.39 percentage points. Doesn't sound like much, right? Let's do the math. Say you've got $250,000 invested. At GPIQ's rate, you're paying about $725 a year in fees. At QQQI's rate, you're paying $1,700 a year. That's a difference of $1,975 every single year going to fees instead of your pocket. On $500,000, that gap jumps to nearly $2,000 a year. Now, I want to be fair here. QQQI's strategy is more complex. Writing index-level call spreads with tax harvesting built in costs more to manage than a simple dynamic override. So the higher fee isn't unreasonable, it's just real. And one more thing to watch. GPIQ's 0.29% rate comes from a fee waiver that was set to expire around April 2026. When that waiver lifts, the expense ratio could inch up towards 0.35%. That shrinks the gap, but GPIQ still wins this round. Here's the myth most people believe. Fees don't matter when the yield is high enough. Here's the truth. Fees compound just like returns do. A 0.39% annual fee drag on a $500,000 portfolio over 10 years costs you roughly $20,000. That's not small. Smart income investors always check the fee line before the yield line. Quick question before we move on. Are you more of a QQQI person or a GPIQ person right now? Drop it in the comments. I read every single one. Let's see where this audience lands. The tax round. Now, here's where QQQI was supposed to run away with it. The tax story. And look, QQQI does have a real structural advantage, but it's smaller than the marketing makes it sound. Let me explain. QQQI writes options on the NDX index. Those are Section 1256 contracts. What that means in plain English is this. No matter how long you held those options, the gains are taxed 60% long-term, 40% short-term. That's a blended federal rate well below ordinary income. It's a legitimate tax advantage built into the strategy. On top of that, NEOS actively harvests tax losses on the underlying stocks to offset gains. That lets them classify a big portion of distributions as return of capital, ROC. And here's where people assume GPIQ loses. But look at the actual numbers. QQQI's distributions in the most recent fiscal year were about 97% return of capital. GPIQ's? Also about 97% return of capital. Let me say that again. Both funds are running almost identical ROC percentages right now. So the after-tax difference, at least while you're holding, is much smaller than most people think. QQQI's Section 1256 layer matters most if distributions get reclassified as option gains down the road. But right now, on paper, it's close to a wash. Now, one thing most videos skip. ROC is not free money. It lowers your cost basis, so when you eventually sell, your taxable gain is bigger. You're not avoiding the tax, you're deferring it. That's still valuable. A dollar taxed later is worth more than a dollar taxed today, but go in with your eyes open. And one big caveat, if you're holding either fund in a Roth IRA or a traditional IRA, none of this matters. Zero. In a tax-advantaged account, there's no ROC benefit, no 1256 benefit. The comparison collapses to fees and total return, and GPIQ wins both. So the tax round goes to QQQI, but by a much thinner margin than you'd expect, maybe half a point, not a knockout. Now let's get to the part everyone really wants to see, the actual money. Let's say you've got $100,000. You're retired. You need income. In QQQI, at the current trailing yield of 13.6%, that gives you roughly $1,133 a month. Real checks every month. In GPIQ, at roughly 9.5% trailing yield, that's about $792 a month. The gap, about $340 a month on $100,000. Now scale add up. Say you've got $500,000. Let me do the quick math. 500,000 times 13.6, that's $68,000 a year. Divide by 12, roughly $5,660 a month from QQQI. Now GPIQ at 9.5%, that's $47,500 a year, or about $3,960 a month. The gap? About $1,700 every single month. If you need the cash to pay bills, that gap is not theoretical. That's groceries. That's a car payment. That's freedom. But, and this is the part most comparison videos skip, let me run the total return side. If you'd put $100,000 into both funds starting January 2024 with distributions reinvested, GPIQ would have grown to roughly $179,000 by mid-2026. QQQI
would have grown to about $161,000. That's an $18,000 gap in GPIQ's favor in about 2.5 years.
So here's the real question. Are you spending the income or reinvesting it? If you're spending it, living off those monthly checks, QQQI puts more cash in your hand every single month. That's its job, and it does it well. If you're reinvesting, building toward retirement, growing the pile, GPIQ's lower fee and higher total return compound faster, and that $18,000 gap keeps widening over time. If someone you know is trying to decide between these two funds, share this video with them right now. This is the part that changes the decision. So which one wins? Honestly, it depends on one thing: where you are in your financial life. If you're retired and living off of dividends, if you need maximum monthly cash hitting your account, QQQI is the pick. The 13.6% yield with monthly payments and the Section 1256 tax advantage and a taxable account is hard to beat for pure income. If you're still building 3 to 10 years from retirement and you want your money working as hard as possible with a solid yield on top, GPIQ is the smarter core holding. Lower fees, higher total return, more upside capture when the Nasdaq runs. And here's one more thing I want you to know. These two funds are about 99% correlated. They move almost identically day to day, so holding both doesn't give you diversification. What it does give you is a dial. You can tilt toward income or tilt toward growth by adjusting how much you put in each one. That's the smart move, not picking a winner, building a blend that matches your life. Here's what I want you to remember. Yield is what you get paid. Total return is what you actually keep. That one sentence should guide every income ETF decision you make. So tell me, are you on the income side or the growth side? And if you hold both, what's your split? Drop your answer in the comments. I want to see how this community is building their portfolios. If you're building income from your investments and want to stay ahead of changes like these, subscribe to this channel. We break down the funds, run the real math, and keep it honest.